Well, hello, everyone, and welcome. This is Cynthia Tomain with Interactive Brokers, and thank you for joining today's presentation being brought to us by Global Beta Advisors. Our topic today is who's in the market's driver's seat. Now, with us, I'm very pleased to have Vince Lowry, who is the CEO of Global Beta Advisors. Now, prior to founding this firm, he was a managing director with Citigroup's Smith Barney Consulting Group. Vince then started VTL Associates in 2004, where he used his experience developing global asset allocation models to create a family of revenue-weighted exchange-traded funds in conjunction with Standard & Poor's. In 2015, VTL merged with Oppenheimer Funds, where Vince was the lead portfolio manager until August of 2017, when he founded Global Beta Advisors. Now, I'm also pleased to have Justin Lowry, who is the Chief Investment Office at Global Beta Advisors. His responsibilities include the oversight of investment activity, market research, and product development at Justin joined the firm as an executive member on its foundation. Prior to working at Global Beta Advisors, Justin worked at Oppenheimer Funds as the head research and product development for its beta solutions. So we've got a lot of talent here with us today. I want to thank you, gentlemen, for joining us. And I'm going to go ahead, Justin, and make you the presenter. While you are grabbing the controls, I do want to ask everyone to join me in welcoming both Vince and Justin for today's presentation. Thank you, gentlemen. Take it away.
Thank you, Cynthia.
Thank you.
Well, hello, everyone. This is Vince Lowry. I will start off with what we'd like to discuss with you, and we're very hopeful that you will find this useful in your business. One of the things that our firm does, we have created 4 single-factor strategies, again, working with our old colleagues at Standard & Poor's, as well as 2 multi-factor strategies, as well as a global ETF model that we have a 10-year track record where we've been managing. At the end of December, we had a full 10-year GIPS-compliant track record managing this global ETF model. But today what we'd like to do, if we could just go to slide 2 with our outline, we want to discuss with you our view of current market conditions, the Federal Reserve, particularly the Open Market Committee, understanding how the Fed has operated in the past, and the state of economy and where we are today, and why we are where we are, and what we think will be going forward. And so that you will be in a position to position your portfolios based on the economic conditions that are being created today by the Federal Reserve. So if we could just jump to the current market conditions as of now, we want to discuss the intraday market volatility, what the Fed has been doing, the $50 billion a month that was once on the table, where the Fed was going to reduce their balance sheet by withdrawing $50 billion a month in liquidity from purchasing the bond portfolios that was part of QE1, QE2, and QE so on. Also, the trade war, if you would, with China. I don't think that's over yet. We want to discuss just briefly some of the issues there. Algorithm trading and the government shutdown. So the intraday trading, the market volatility right now that you can measure by looking at the VIX is not really as bad as it has been in years past. Recently, in the fourth quarter, when the market sold off, the VIX may have gone up into the 30s or so, and maybe even low 40s, which is high, but it was not like it was in '08 and '09 when at one point I think it went over 80. That was an extraordinary event. But right now we're in a market that is um, being taken over by a lot of trading. So the short-term fluctuation is more trading and algorithms taking place. And when those algorithms kicked off in the fourth quarter and created that 18-19% correction in the market, there was a lot of stability in the market outside those trading algorithms. But as someone that's been in the business for a long time, the Federal Reserve is at the heart of what is taking place today. The Federal Reserve, the way they set up last year, and I'm going to give you my experience. I was around for the '87 collapse, the '94 bond market rout, '92, '94, the '99 collapse, the '02 collapse. The Federal Reserve had its hand in each one of them, and the issue that occurred in December, where there was friction between the President of the United States and the Federal Reserve, which is not unusual. The Fed went in and raised rates in December, another quarter of a basis point, and that was an add-on that was taking place over the past year, all during 2018. When we look at that, most of the market was accepting the rise in rates, and they were accepting the fact that the Fed was going to go in and start reducing liquidity and reducing their balance sheet by $50 billion a month. But the way the Fed presented it was that this was on autopilot. And that was concerning to people. How could you put something on autopilot where they were projecting 3, maybe 4 rate hikes, and that the $50 billion a month was coming off the market? Now, understand that $50 billion a month is a direct hit. It's not like the normal raising of rates where they run liquidity through the banking system. This was a direct hit to the liquidity of the market, and it has no lag time. When you do these QE2s, or let's say QE tightening now, before it was QE loosening, now it's QE tightening, these are things that go directly to the market and create liquidity issues right away, whether it's deflationary or inflationary. And those that have been around for a long time really began to panic on that. And that really caused a severe sell-off, much more than was required at the time. But now this has positioned us going forward. And the way this has positioned us going forward is we are going to change from probably an inverted flat yield curve to where it's going to turn to a steepening yield curve. And the Fed began to realize that they were miscommunicating to the market, and that no one wants the Federal Reserve to be on autopilot. When we go back to what the Fed is supposed to be doing, it goes back to when it was created, roughly 1914, and there were some adjustments in the early 30s. The whole idea was price stability. Today they say, well, our goal is maximum employment and price stability. It's when they leave that mandate that they were given in 1914 of trying to maintain price stability by looking at inflation, mostly looking at productivity numbers versus inflation. That's when the errors occur. They did so in the 30s by over-tightening. They reduced the money supply by 1/3 at that time, from 29 through 1932. It just turned a normal recession into a depression. The next time the Fed began to do things outside that simple mandate of maintaining price stability and maintaining inflation was in the 1960s, when President Johnson was He was embattled with the Vietnam War, and that was costing nearly $1 billion a week. We had the new society that he wanted to expand on, and he pressured the Federal Reserve to create more dollars back then, not like what they were doing today. Create more credit, push credit out the door, and within about 10 years, that created the crisis in the 70s. Now, I'm giving you this backdrop to kind of place us where we are today. When Volcker came in, he kind of reversed the entire Federal Reserve operations from the 60s, brought inflation back under control. By 1994, from the late 70s, and it took about 1994 where inflation was actually broken in 1994. It had a little blip in 98, 99. With Greenspan in there, he was a little more mostly data dependent. He pretty much kept the Federal Reserve. He got a little bit off with the talking about the stock market and bubbles, and he began some tightening in 99, and that eventually broke the market, and we had the O2 problem. But what has happened now is this whole QE, this quantitative easing that was taking place now, quantitative tightening, is completely different. As I mentioned to you before, this is directly going into the liquidity of the market. And over the last 10 years, growth stocks have dominated the market. As a matter of fact, last year, it was the widest spread of growth over value since 1999. And much of that is because of the slow growth environment. Those of you who have been around for a while understand that when growth is slow, people will chase companies that can grow their earnings in a slow growth environment. In this case, we had the same thing happen as in 1999. Right now, the S&P 500 had gotten up to around 2.3 price to sales versus around 2.4 in 1999. And it was a basket of stocks that were growth stocks that were driving the market. It was both at the large cap level, the mid cap level, and the small cap level. And when the Federal Reserve came in and it looked like they were beginning to tighten, people began to believe that, this seems as though we should be shifting to value, and that started to happen in the fourth quarter. But an unusual thing occurred. The bond market was saying no, that the world economy is slow, and the Fed is going overboard, and people were reading into that autopilot strategy and adding that extra rate hike as what are they looking at? And when they started to hear what the Federal Reserve was looking at, they realized that this was a Federal Reserve that was really looking over their skis, and the biggest problem was the quantitative tightening. And I think that's what had people most concerned. As a result of that, the market really collapsed. But now this has created, and where I'm trying to bring us right now, this has created a scenario where we're probably going to be looking at a steepening yield curve. And some of the data that has come out is kind of counterintuitive. We've seen the Federal Reserve, when it was doing its quantitative easing, the 10-year actually was going up. Rates were going up. And that was really strange. The short-term rates were going to almost zero, almost negative, but the 10-year and the 30-year were slightly moving upward. When quantitative tightening occurred in 2018, the reverse happened, which is counterintuitive. When they were tightening, rates started to go down. And most economists look at that and say, that's because the market is now shifted into an anticipatory scenario. It doesn't react any longer. The bond market is really being anticipatory, and they're seeing a tightening, and that's why the yield curve inverted so rapidly, and the market collapsed on its own weight because they just felt the Fed was going to throw us into a recession. It was almost certain, and that was going to create problems in China. It was going to exacerbate the China trade war, and everything came at one time. It was a perfect storm, and we had the correction. But what we see happening now, and why this is important to your portfolios, is that we think that the Federal Reserve really learned a lesson. I think they were very worried. It wasn't who was right, whether it was the president right or they were right. They misread the market. Everybody misread the bond market. They should have been paying attention to the bond market. The bond market was telling them that there was a global slow up, and that's where more valuable information was coming from there, and that they had to realize they have to pay attention to the markets and not create not worry so much about transparency that you create this long-term. Well, we're gonna reduce the balance sheet by X amount for X amount of years. Nobody wants the Federal Reserve on autopilot, particularly when you're dealing with tightening. So now they're, in our view, going to keep those short-term rates because they have to keep the stock market up. The stock market has to stay up because the entire pension system, both at corporate and public level, are dependent on their funding levels to stay up. So it's a very serious problem if that stock market were to drop down 30 or 40%. So the Fed has really no choice but to keep those short-term rates. And that is going to, with the tax cuts and other stimulus that's taking place right now, is probably going to cause a steepening in the yield curve. There's going to be an anticipation of the economy expanding. And we believe that it's at this point that you're going to see a more shift from value, from growth into value, particularly at the small cap. If you notice, small cap value has been doing very well at the beginning of the year as people shifted. They've seen the Federal Reserve is going to be more accommodative. They're going to want the market. They're going to accept more inflation, and that inflationary period is going to expand around the globe, and that's going to create higher long-term rates and probably shorter, less or short-term rates. And that will be very stimulative to the economy. But what that will do is that will kick off particularly small, mid-cap, and large-cap value strategies that will begin to position going forward. And that brings us into where we want to go with having Justin review some of the factor strategies that we have created. And what we have done is we have focused on price to sales. So when we create our factors, such as our value factor, we have a low vol factor, we have a momentum growth factor, and we have a size factor, and then we have two multi-factors that we manage, and we manage that around a price to sales. So we take each factor and we have a whole history that we've created on the price to sales, kind of like a moving 200-day average of the price to sales of each factor. And when they are entering into an area of being overpriced, and when they're entering into an area of being at the lower end. And probably for the last year, pretty close to last year, we've had a big overweight to small cap, to the size factor, and we've had an overweight to large cap value. That bet that probably went on for almost a year now has really begun to pay off, and it'll probably pay off, and we could go into a long-term scenario where, of course, growth's going to come back and there'll be ebbs and flows, but value strategies and mid-cap strategies and small-cap strategies, particularly with the value bent, could go on a very long-term outperformance versus the substantial underperformance they've had, because the spreads are so wide now, and that the rationale for all that was the slow growth economy, and even through last year when the Fed began to raise rates, it was just tremendous for growth stocks again. Now they began to realize they're not going to be able to get out of this that easy. They're going to have to allow inflation to come back and take place and begin to seep back in, and they'll have to deal with that in the next year, 2 years or so. But during that period of time, I think you're going to see real valuations occur, particularly in the small cap area. With that, I want to turn it over to Justin and have him just go through our global ETF model. It has a 10-year track record for those of you that would like to have a global model managed for you. We have that available. Or if you just want a multi-factor where we use our price to sales to weight or on, we always own every factor. We never make one big bet, but we take overweights to value or size based on where the price to sale is on a historical level, and we underweight those areas where the price to sales is higher. So right now the price to sales on growth is off the charts. So the price to sales on small cap value or small cap stocks and mid cap stocks are at almost historical level lows. We're overweighting there, but we don't bet the farm on it in these multi-factors. And Justin will go through all this with you, and I think I'll just turn that over to him. Justin, you want to review that so you
go
through the details?
Yeah, thank you. I noticed briefly before I start there was a comment in the questions section that there may be quite a few terms that people aren't familiar with. At the end, we can open it up to questions, and if people weren't sure of some of the terms that Vince was speaking to, we can certainly address that in the questions section. Now, again, we have the slide up here. What does it mean for your portfolio with all of the macro issues going on? The market in general has been kind of, and that's the theme of this presentation, the market has been driven by these headline issues. Is it algorithms bidding up the market? Is it the China trade war tugging away at global trade and how that's affecting the market? And you have a lot of traders trying to bake all those macro ideas into forecasting what is going to happen in the next 12 to 18 months. And for those who are not as experienced with trading, I'll tell you that the biggest thing with the stock market, what you see today isn't what people are trading on. People are trading on what they think may happen in the future. And because of that, as Vince was alluding to, you have these ballooning or contracting valuations that get away from a lot of the fundamental investing that should be occurring for long-term return growth. And I think many people on this call aren't looking for that quick, dollar, day trading dollar. They're looking for a sustainable investment. And the key to that is being able to block out a lot of the noise that's going on in the market right now and kind of identify where within the market presents a lot of value and a lot of potential growth. And, that's kind of where we go right now and segue into our portfolios. So on this slide here, the solutions, we've developed one ETF rotation model that we've been managing for a large institution for the past 10 years. It's got a good track record over that time period. It's been outperforming the benchmark by about 150 basis points on an annualized basis. And again, that's a live track record. The other strategies are index-based strategies that we've recently developed. The performance on that is hypothetical at this point. But again, it was important for us to go ahead and develop that hypothetical performance to measure the efficacy of those strategies. And as you'll see, we've identified what we believe are the most prevalent factors in investing. And when we say factors, people like to generalize what that means, or there's a misperception about what that means. And what it really means is, as we've kind of went over the whole macroeconomic environment, what people are ignoring is, what is the idiosyncratic investment part. And by that I mean, just the general behaviors of investing in certain types of securities. So and that's why we decomposed the S&P 500 and 600 indexes to kind of develop these strategies that you see here. So we identified value, quality, growth momentum, low beta, and size as the most prevalent factors here. And through those factors, we rotate those factors into the all cap and large cap multi-factor strategies. So I'll go ahead and review those in the next slides here. So we'll start with the all-world ETF rotation model, and really it's a multi-asset class all-world ETF model. And what we've done is we've combined ETFs and some passively managed index funds into an overall rotation model strategy. And again, the way that we look at investments is very much on a fundamental basis, because the fundamentals are really kind of what grow an investment for a long period of time. And we've done regression analysis on specifically the price to sales ratio. And price to sales ratio is simply the market value of a security divided by the 12-month trailing sales of that company. And that gives us a barometer of how much more is the security trading relative to its revenues. And we think that barometer gives you the lifeblood of what a company is going to return you in the future. I mean, the higher that a company is trading relative to its revenues, the more it has to grow to justify that valuation. And so for us, as I said before, we built regression analysis on the S&P 500 index. And over time, we plotted out periods in which the S&P 500 was trading, on the lower end of its price to sales valuation, and when it was trading on the higher end. And we found that there was a 90% correlation between price to sales values and future 10-year returns on the S&P 500. And that relationship was generally when the S&P 500 was trading on the lower end of its price to sales metric, the 10-year return was higher than if it were trading at that higher multiple. So that's generally the crux of how we measure our rotation model, specifically as it pertains to equities. And then we do that for both domestic and international, and we put it together as a global model. And we also look at again, different types of things for fixed income. We look at risk category, credit spreads, duration risk, and convexity. And for us, we believe that fixed income, can really be supplemented by a liability-driven investment. And by that I mean, what we do is we kind of, depending on the client or the institution or whomever we're dealing with, we want to kind of look at, what kind of other than making money on investment, what kind of liabilities do you have? And we can kind of supplement it through this liability driven investment program to, really be able to match returns to kind of fulfill those liabilities. So we really look at fixed income as a supplemental income part of your asset allocation, and the equity is supposed to kind of give you the juice to maximize your return further. And again, as we said, and we spread this out, and we look at it and we figure out, when our equities kind of more favorable to fixed income. Generally, we'll always tilt more towards equities, but again, that evaluation occurs. Every day we're looking at what's going on in the market, what's going on with the different investments that we have, and we make that allocation decision. So the single factors, we'll start with them. Again, broken down into really 6 factors, but we found that value, quality have a high correlation, and growth and momentum have a high correlation. So we've kind of bundled those factors into one index apiece. And as you'll see, we really decompose the S&P 500 to derive each index strategy. And we think that's a very efficient way of doing it, because if you take the S&P 500, it's a representation of the U.S. stock market. So it really has embedded into it every factor of the market. Now it's just a matter of how do you kind of reach into the S&P 500 and pull out those factors and really kind of concentrate that portfolio so that you're getting the exact factor that you want for your portfolio. And so we feel that we've developed those inputs to maximize each factor on a standalone basis. And so you'll see here with the value quality index, we take the bottom quintile of the S&P 500, so 100 securities, and we look at it by price to sales ratio. And as I mentioned on the previous slide, we believe price to sales is a great value barometer for future growth. So it stands to reason that we believe that if you have the lowest price to sales stocks, that's going to give you the highest value, highest quality level stocks for future returns. So we take those and we take those 100 stocks and we measure out their 12-month trailing revenue for each 100 securities. We add up those revenues and we divide each revenue into that denominator. And then that gives us the weighting scheme for each 100 security, each 100 of those securities in the portfolio. Now, we want to make sure that we don't have a huge concentration in any individual security. So what we do is we cap each security at 5%. So there's not one security within that basket that will exceed 5%. And anything that is in excess, we just prorate across the portfolio. And then the next strategy here, growth momentum. So again, we kind of really did a lot of testing with this, and we feel that risk-adjusted return, trailing risk-adjusted return, as many people would imagine, and just to give you context, Sharpe ratio is a risk-adjusted return metric, and what it does is it just measures for every amount of return that you get relative to your standard deviation. So the standard deviation is the amount in which the returns deviate from month to month. And so basically what you want to see is you want to see the ratio higher, because that means you're getting more return for the risk that you're taking in that security. And generally speaking, that kind of gives you a measurement of momentum. But momentum is also correlated with growth, because growth stocks are really kind of securities in which that people buy based off of earnings growth rates in a 3 to 5 year period. So when you see momentum gaining in the market, those are just growth stocks that are being bought up because there's a huge demand for the higher growth level stock, the higher earning or higher future earning level stocks. So we've simplified it to just say, let's look at the Sharpe ratio of the top quintile, top 100 securities of the S&P 500, and then we'll weight that by market cap. And then we'll issue a 5% cap to that, so you don't have any security that's overly concentrated. Now, the low beta strategy, as you can tell from the name of the index, that's just, we're looking at beta, which beta relative to the S&P 500. So beta is just the amount, it's basically the amount of correlation you have to a given benchmark. So in this case, a low beta stock means that there's a lower correlation and a lower level of risk relative to the S&P 500. So what we're doing is we're looking at the lowest quintile of beta stocks, and then we're weighting that by revenue, similar to how we did with a value quality stock, and again imposing the 5% cap. And then finally, we're taking for the size index, we're taking the S&P 600, which is the small cap of the Standard & Poor's Index series. We take the bottom quintile. I know it says 100 securities. It should be 125, which would be the quintile, the highest quintile, and that's based off of revenue growth. So one of the biggest things with small cap stocks is they're very inefficient when you compare it to the typical Apples of the world and Googles of the world and IBMs. Small caps are much more difficult to trade, and they have a lot of arbitrage going on in the market, which means that their trading spreads are wider, so you have these high-frequency traders coming in and taking advantage of large spreads. And so it's very important that you kind of really stay disciplined when you're investing in a smaller cap type of strategy. So for us, we really focus on fundamentals here, and we want to look at small cap companies that are growing their revenues, because those small cap companies that are growing their revenues are more likely to kind of graduate into a mid cap or then into a large cap. And by nature, that means their market cap is growing, and that means that their return is growing. So we're taking that subset and we're revenue weighting those, and again, applying the 5% security cap. So real briefly on the all cap and large cap strategies. So as you can imagine, the all cap strategy rotates between those four indexes, and we do that on a relative price to sales metric. So what we do is we look at the current price to sales. If it's one standard deviation above its historical average, then it's an underweight. If it's one standard deviation below its historical average, then we overweight it, because we look at the index relative to where its price to sales has been over time, and that means that it's a good time to buy that index or it's not as good. If it's somewhere in between, we just equal weight it. And they're all fully invested, so wherever the numbers lie, we just prorate the excess into the strategy. And then that's for the four indexes. The Global Beta Large Cap Multi-Factor Index does the same thing, but it does it without the size factor, because the size factor is, as you can imagine, it's an influential part of return in the all-cap strategy. So we wanted to create two multi-factor strategies that allows you to have exposure to that size factor, and then another iteration that has without that part of it. So it's both are hypothetically back tested and have outperformed over time at their benchmarks.
And this is Vince again, and we've created these. Our target group of people that we want to work with are the third-party advisors out there. So we've priced. If you want to use the single factors, we have those priced at very low fees, and the managed portfolios are a little bit higher, but everything is. We believe priced very effectively, so that if you want to put your clients with us or your high net worth individual, but particular, it allows you room to add your fee to the relationship with anyone that you want to place money in these strategies. And we're working with Interactive Brokers right now. They have very, very competitive custody arrangements. There's no fees there. So this is a way for you, the advisor, to access the single factors on your own. You can do your own weightings. Those fees, again, will be very low. Interactive also has a securities lending program, so you can get the overall cost to your client, not quite to zero, but pretty close to it. With the certain factors and the securities lending return the client would receive. And then, of course, we have the ones where we will actually manage it for you. We'll manage the single factors and do the rebalances, but we'll actually manage the factors for you, and that's a different fee schedule. And we can open that up. Anybody wants to have discussions with us on that. Just, did you have anything else to go over?
No, that does it for me. I think we can open it up to questions now, and I actually see one coming over. But if you wanted to add anything else.
Justin, if I could jump in for just a moment, I'd like to remind everyone there is a questions panel that's located over on the right-hand side of your screen. Simply find that title bar and then double-click, and you can add any questions you might have for Vince or Justin at this point. So back to you, Justin.
Thanks. So the first question I see here is, why do you use price to sales instead of price to earnings or price to book or EBITDA? I mean, I can speak first, and then Vince will, I'm sure, have his take on it as well. As I mentioned earlier, we've done a lot of studies around just revenue in general, and for us, there's a lot of the part of the income statement, as you can imagine, that can be massaged by accounting practices, but the biggest number on the income statement that can't be influenced other than productivity is revenue. So we look at revenue as a huge indicator in the growth and success of a company. So as you can imagine, we look at price to sales as a big barometer for future growth. Because again, if the company is not trading up to its revenue, we really believe there's a potential opportunity for future growth there. And we did a regression analysis of the S&P 500, where we plotted out every instance or every monthly instance throughout a 34, 35-year period. And it came back where there was a 90% relationship between price to sales and future 10-year return. And again, the lower the price to sales ratio was in the S&P 500, the higher the 10-year return as opposed to the higher price to sales. And when we measured those ratios, those other ratios in the S&P 500, the correlation rate wasn't nearly as high. I don't have the specific figures, but they were significantly lower than 90%. Another question that came over is, why do value stocks perform better than growth stocks in an expanding economy? Vince, I don't know if you wanted to take that.
Well, the reason the growth stocks tend to do better where the economy is slower and it's very difficult to get growth. So if you have an Amazon, you have Facebook, and they were growing revenues at maybe 30 or 35% a year. Amazon may have been a little higher. The investors are willing to pay up for that in a very low growth environment, so that creates an expansion of price to sales. However, when the economy begins to accelerate, most value stocks have really boned themselves down during slow periods. So every incremental dollar that comes in has a tremendous impact on the bottom line. So if they were able to keep those fixed costs and even their variable costs under control, and the economy picks up, it has an enormous impact on their bottom line over time. And when there is some inflationary periods where inflation builds up a little, they have some pricing power. I believe it was Apple tried to increase prices, and it hurt them substantially in that low growth environment. They might want to go back next year if inflation begins to pick up to get some increases in some of the products they want to sell. But that's been a historical. We got data back all the way into the 1920s, around value stocks and how they perform as GDP begins to expand. And we think that that's the case. GDP may very well maintain themselves as long as the Fed does not cut off the growth of it and allows the economy to pick up and get to that 3% growth level, 3.25. That's a period where the valuations of growth have gotten so high. There's just going to be a natural shift just on a valuation basis. This isn't speculation. It happens all the time. If it doesn't happen, then it's a very low probability event that it doesn't happen, because history is just replete with this is the type of period that a well-managed price-to-sales portfolio will begin to outperform.
Another question came over. You talk about value stocks as a point of emphasis as we begin 2019. What does that mean for your overall portfolio?
Josh, why don't you go over to multi-factor and point out what that's done? And I think that would be a good way to answer that.
Yeah. I will say, though, that for global beta, that means stocks with attractive valuations, again, as measured by price to sales. And some of the three of the sectors that are extremely undervalued right now are healthcare, energy, and consumer staples. One of the largest companies in the consumer staples sector is Walmart, and they just recently came out with their quarterly numbers, and they showed 73% year-over-year earnings growth, which is really impressive, and a lot of it is attributed to their e-commerce growing in competition with Amazon. But as Vince mentioned, specifically with our all cap strategy, it's nicely positioned where we've got a nice exposure to size, which our size index for the month of January was up around 19%. I know the market cap or the S&P 600 was somewhere in around 11%, but just in general, small caps performed well in the month of January. Our strategy specifically performed greatly, but it just is a testament to the fact that small caps were beaten up so poorly in 2018 that our strategy naturally picked up on that opportunity through price to sales valuation, and really kind of allocated a good portion of the portfolio, and that kind of drove its return to about 10.15% for the month of January. Looks like there's another question here. What do you expect the market to do in the near future? Go up, another correction, sideways?
I'll take that for now. I think that the market is highly focused, probably too much so, on the trade talks going on right now and with China, and just a little bit of knowledge. When I had revenue shares, we had a Chinese private equity firm from China invest in us, so I got to know the Chinese. I wouldn't call myself a diplomat, but I was involved with them in making investments, and they're very pragmatic, and you just have to continue to be pragmatic, and I wouldn't expect anything dramatic to occur. So I do think that if there isn't like a convincing trade deal done, I think the market could correct, but I don't think it'll do more than a 4 to 8% correction. But I would prepare for that, because I am not optimistic that there's going to be that there's going to be a trade deal that the market's going to embrace. the Chinese move very slowly, very deliberately. They're going to want to get a deal, but if you read some of the works that are coming out, a young man used to head up Google China, just wrote a book called Artificial Intelligence and the China-U.S. Trade War. I read that book, and it's fascinating. I think we're expecting too much. So in the short term, I'd be prepared for a disappointment correction. I think when a deal is announced, people will jump on it. The market might go up 3, 4, 5%, but then I think you're going to see a correction when they get to the details. That's and it's all speculation on my part, and it's just based on my experience dealing with Chinese.
Yeah, I think you can tell that potential Chinese deal is baked into the market. So anything short would be a disappointment. But I think as we kind of alluded to, there have been a lot of or not a lot of, but there have been a few people that have been calling for an upcoming recession, and the recent economic numbers are not really pointing towards a recession per se. So that's why we think that it's important to be disciplined and find value opportunities, because they do thrive in an expanding economy, which has been going on for a few quarters now.
Yeah, but I just think the U.S. economy and the tax cuts, and remember, it's not just last year's tax cuts, it's each year. I think we haven't had a CapEx, a capital expenditure bull market yet. We've had mostly all consumer, and we really haven't seen the CapEx part of the bull market, which is normal part of an expansion. And I do expect to see that part of, and that's where value stocks really benefit more from CapEx expenditures. Yeah, that's reinvesting in the companies, the capital expenditures.
Another question, would you elaborate on what you think caused the correction starting in October?
Yeah, I believe that it was the terminology. Well, in November, I believe, is when they first started announcing the $50 billion reduction in the Fed's balance sheet, which was what at the time was between roughly $4.5 billion, maybe a little over $4.5 billion, and they were going to reduce it by $50 billion a month. So that is the reverse of the QE, quantitative easing. That means they are directly going into the market and pulling liquidity out of the market by selling bonds into the market. That draws cash out of the market and reduces the Federal Reserve's balance sheet. When they said they were just going to put it on autopilot, really, when I don't want to call them smart people who are close to the market, who've been around a long time, realize that's it's almost like you take medicine, you take it by mouth, it goes through the liver, and it takes time. If you take medication by injection, it goes right into the system. Well, it's the same thing here. When the Fed uses interest rates, it goes through the screen of the banking system to create or destroy credit. In this case, they're doing it directly. And those people that look at that, who've been following those things for a long time, automatically just felt this is going to create a recession. And then when the Fed just said, well, we're going to have 3, 4 interest rates, and then the battle between the president and the head of the Fed, I think all those things came together and said, we're going to be in a recession. And, the Fed is going to dig their heels in. And we think the Fed's not paying attention to what the marketplace is telling them about global growth. And I think that set off a panic. When the Fed changed their mind, as a matter of fact, I think right over the last few days, that whole $50 billion a month is off the table now. And I'm not saying whether it's a good idea or a bad idea, but being around the marketplace for a long time, I think that has people feeling that now we're going to end up with a steepening yield curve, and that's why we got the rebound. But I think the correction was all around the Fed missing the target, over tightening, and creating a a recession in the U.S. because they overdid it.
And I think that, for both October and December, you had, again, back to the presentation where you had algorithmic-based trading where they're taking those qualitative concepts coming out from the Fed and, from the potential Chinese tension, and they start to create a wave of selling. And, as you probably have heard from, the talking heads on news station, oh, well, there's capitulation in the market, and it's just, it's one of those situations where you have selling feeding on selling, and you start hitting stop losses, which is basically traders, what they do is they put a price limit on their investment, and they say, if the current market price of my security goes below X, sell. So when you have those stop losses getting tripped, it just is a feeding frenzy on selling, and then you get over exaggerated selling in the market, and that's why you saw a large bounce back in the market for the month of January after the big sell-off in December, because it was so overdone, and it wasn't as though that there was a lot of changes in the macro environment. So the next question here is, do you hedge the portfolio in any way, or is it long only?
We just do long only, right? Mm-hmm.
Yeah, we only do long only. I mean, that's not to say in the future with some global or international strategies we wouldn't do hedge out currency risk, but right now we just do long only. I think that does it for unless anyone else has any more questions. I think we're out of questions. Oh wait, looks like one more came in. What was your? Sorry, there's a couple of questions that came through. What was your performance in the month of October, or what was your performance during the correction?
And on the global ETF model, and we have performance on all of them, but what was the global ETF model?
Global ETF model. I don't have that exact number up right now, but I can certainly follow up with you on performance for all the strategies in that particular.
Well, I'm pretty sure that it outperformed. It's measured to the all world, and we had, we were probably running 14 or 15% in cash. So we outperformed in December. But all our performance will be up on our website, so you'll be able to track it all. Each of the strategies, they're all funded. The only one with a 10-year track record is the global ETF model, and you can we have all that updated on our website, and you'll be able to track it by year and rolling periods.
And just to let you know, the benchmark for the performance of that global ETF rotation model is a blended benchmark. So what we do is we take the MSCI All Country World Index and the Bloomberg Barclays Aggregate Index, and we do an 80% to the All Country World Index and 20% to Barclays Aggregate to give us a sense of a multi-asset class benchmark that's comparable to our exposure. So when we say that we outperform for that period of time, that's the benchmark that we're talking about. But again, I'm happy to follow up, with specifics if you'd like.
Okay, well, with that, looks like we have come to the end of today's presentation. I want to thank Vince and Justin for a terrific presentation here today, and also for all of you in attending. I do want to remind you we have been recording today's session, and each of you will get a direct link to the associated slides and today's recorded playback soon after this session ends. Now, if you're watching this via a recording, also want you to know that the webinar notes will be available on the Interactive Brokers website. Underneath the Education menu, you'll find a webinar section where you can access any of our upcoming webinars, but also any of our prior webinars and the webinar notes. So with that, we are going to conclude today's session. Thanks all for your participation here today, and have a great rest of your day. You can exit using the X in the upper right-hand corner of the screen. Thanks so much to Global Beta Advisors for today's webinar, and to all of you as well. Thanks. Have a great one.
Bye.
Thank you.